Well, let's get across the market open. Zach Riaz joining us from Banyan Tree Investment Management. Zach, great to have you back here at AusBiz. Let's start with that overnight session in the States.
Yep.
My goodness, tech stocks savagely sold off, all on this emergence of a AI player out of China.
Well, it shows you that everyone's working towards a cheaper and better option, and China obviously being outcast from, high-tech chips, had to go out and reinvent themselves. And look, there's still a lot of news that needs to you get across. There's a lot of water that needs to get under the bridge before we understand what the real impact is. But in a very simple terms, what we've been reading about it could be positive for the likes of Meta, Apple, and who need cheaper chips. And it could be a better supply effect, supply side effect in terms of lower cost for small to medium businesses to get on this whole AI train. But obviously negative for guys like Nvidia, who have been absolutely making hay while the sun shines. So look, still a lot to get through, but it just shows you everybody around the world is working towards some sort of AI model. What's very interesting is someone sent me a picture of a story of a French AI model which had to be taken down because it was spitting out the wrong answers. So, not all models are created equal, Andrew.
Maybe it was lost in translation. So was that also, I guess, an excuse or an opportunity to just a bit of a correction there as far as stocks, given how far they've run, particularly in the tech side?
100%. So we've got exposure to the likes of Nvidia. We're well below where the market is. That's a function of us just having a particular comfort level with the level of percentage that we have exposed to each stock. But overall, look, things haven't, they have done so well over the last 12 months. So a little bit of air coming out of these stocks is not necessarily a bad thing. But like Meta is up, Apple is up, there are winners as well. So you just got to be careful, manage your positions. But like you said, I think if you've been in these stocks over the last 2-3 years, last 15% is not going to be a massive kick to your portfolio.
All right, well that's just one session, of course, and we look ahead to this year. Volatility.
Yeah.
How do we rate that, I guess? We're at the moment, markets expecting volatility, certain coming from the Trump presidency and given so many unknowns.
Yeah, absolutely. So candidates to spur on volatility are vast and numerous, but I think the point that we just want to make is everyone's talking about volatility will rise. Yes, it will rise. But if you just do a very simple analysis of long-term annualized volatility across all these asset classes that you can see on your screen, and you just compare it to last year's volatility in calendar year 24, you can see volatility by long-term standards or long-term averages was well below. So increase in volatility, and that was across most sectors. I think the sectors that's experienced volatility above their long-term average was bonds, which it shouldn't come as a surprise. So if there is an increase in volatility, the question really is: Are we just normalizing to back to long-term averages as well? So volatility increasing shouldn't just make people nervous just simply by looking at long-term averages. And you shouldn't just jump to conclusions that something's happening underneath the surface that's untoward. So all I'm suggesting is that given the suppression of volatility that we've experienced relative to long-term average, a little bit of volatility increase may be just a normalizing impact.
All right, so how's this all play out as far as what we can expect this year in terms of returns? And I guess, it's often said history doesn't repeat, but it does rhyme. Is that what we're likely to see, do you think, as far as those returns are concerned? Yeah,
look, so we've got a couple of big non-consensus calls out there. Look, everyone puts out their calls. But look, a couple of things that we would suggest is look at the 1995 to 1998 period. That's the last time the Fed manufactured a soft landing. So we think, the market could continue to deliver double-digit returns. I mean, obviously, the key candidate is you've seen the investment that goes in AI. That's still going on. And look, if Deepseek is something that's got something valid behind it, that will lower the cost. That could actually spur on more investment at a lower cost, which is a lot of people concerned about. Then economic conditions in the US holding up, China stimulating. So there's various candidates that could actually push this out to a soft landing and potentially some sort of a re-acceleration of economic growth or stabilization. That could very easily deliver double-digit returns. And don't forget, Donald Trump has come out and really wants lower interest rates. So look at that 1995 to 1998 period. Look, on the flip side of it, I think the other period that you may want to look at is the 1927 to 1930. That's the Great Depression. And there are some similarities there as well. And one of the similarities that I'll point out is actually not anything fundamental or economic based, but it's actually the lack of trust that the communities and the constituents now have with lawmakers and politicians. And you've seen a lot of politicians lose their seats. The French president, obviously, what's happening in Canada as well. So there's a lack of trust, and that has similar sort of ringtone to what happened in the 1930s, around the 1920s, 1930s, around the Great Depression. So, a couple of eras to compare to.
Well, yeah, interesting to see whether we do get to that repeat, if you like, 100 years later of the roaring 20s that all came apart in the early 30s.
Yes.
Zach, given that volatility, perhaps investors seeking safe haven, how are you viewing gold at the moment?
Yeah, look, I think we're very bullish on gold. We have been bullish on gold for the last 2 years. So I don't think that's a big out of consensus call. I think where we do see is gold price probably leads to about $3,500. That's our price target based on the valuation that we've done. Look, one of the big things about gold is some of the old correlations to gold have broken down, obviously around real yields and whatnot. But I think the biggest characteristics that people don't appreciate is, have started to really appreciate, is that it's genuinely becoming a safe haven when likes of US Treasuries, US dollar are starting to wobble a little bit. We're not saying they're going to completely lose their mantle. All I'm suggesting is most emerging countries, most ex-US investors are looking at gold as a genuine hedge against inflation, as a hedge against US sanctions. And so we see gold going to $3,500.
And how are you playing that? Are you buying the physical asset, or are you liking
physical
gold
assets.
stocks?
Yeah, physical assets. Look, I mean, and that's a great learning in there right there, because gold stocks, junior miners, and some of the gold stocks have really lagged. So if you're going to play the asset class, play it as cleanly as possible. So a simple gold ETF, Global X Gold ETF, or even a VanEck will get you the exposure. All
right, just a quick look at a stock you're liking at the moment, SiteMinder. Why is that?
Very quickly, software business, open source, provides basically software solutions to bed and breakfasts, hotels around the world. Over 40,000 hotels and bed and breakfasts that it's got on its books. It's got a subscription model. It's got a transaction model. Over 150 companies. What we like about these guys is very strong market positions. It allows small to medium bed and breakfasts and hotels to manage their inventories, rates, both on the internal systems and on external sales channel. And it's a simple subscription model. It's starting to really focus on transaction-based money as well, which is really starting to come through. And at the end of the day, there's a couple of interesting things that could have come out in the first half of 25 results, which is on end of February. They've just launched new products in the last 6 months. Really positive updates around that. Could see the share price rally in our view. So good stock.